Folks, we've just witnessed an economic earthquake in a move that will define the next decade. President Trump has removed Jerome Powell as Fed chair, replacing him with a known hawk, Kevin Warsh. By February 15th, the markets are in chaos. But the real story is the historic split happening right now between gold and silver. Gold is crashing through support, down to $4,500 after its highs. But silver? Silver is holding absolutely firm at $82. This isn't a mistake. It's the market telling you exactly where the real opportunity and the real danger lies. Let's connect the dots everyone else is missing. Powell's exit ends the inflation trade as we knew it. The market now sees the Fed under Warsh hiking rates aggressively, even into a potential recession caused by new tariffs. That's why the dollar is soaring, and that soaring dollar is crushing paper gold. The narrative that gold is the only hedge is dead for now. Gold ETFs are facing margin calls. The momentum is gone. But silver is playing by a completely different set of rules. This isn't just a metal you hold. It's a metal the world's most critical industries must use to function. Solar panel factories globally consume over 200 million ounces a year. Electric vehicle batteries need significant silver per kilowatt. Hey, a company like Tesla alone could need tens of millions of ounces annually to keep their production lines moving. These are just-in-time operations. They don't have stockpiles. If the silver stops flowing, their factories shut down in a matter of weeks. They will pay whatever it takes to get it. Now, layer on President Trump's proposed 25% tariffs on goods from Mexico and Canada. This isn't just political news. It's a direct attack on silver supply chains. Mexico is a top global silver producer. Those tariffs mean that silver stays in Mexico for their own domestic use, not for export to the United States. Canada is a major source of silver as a byproduct of mining other metals. Those flows get disrupted. At the same time, China has already been restricting exports, draining physical metal from the system. This has created a historic physical shortage in the registered vaults of the COMEX, the world's key trading hub. There are now over 6 paper claims for every single ounce of deliverable silver. The leverage is unsustainable. This is why, while the spot price might say $82, if you try to buy a 1 kilo bar of physical silver today, you're likely paying a massive premium, with delivery times stretching to 2 months. The spot price and the physical price are becoming two completely different things. The panic signals are already flashing. Major U.S. silver mining stocks are skyrocketing after hours because they represent pure domestic supply in a tariff war. Major online bullion dealers are reporting sold-out signs and week-long backorders. Internally, manufacturers like Tesla are reportedly bidding well over $100 an ounce to secure supply, while the official COMEX price lags far behind. This disconnect cannot last. So, here is your reality and your playbook. First, understand the new rules. Gold's story is broken for the moment by a strong dollar and a hawkish Fed, but silver's story is about industrial survival. Its price floor isn't set by traders in New York. It's set by factory managers in Michigan and Nevada who need it to make their products tomorrow. That floor is unbreakable. Your execution must be precise. Prioritize physical silver above all else. Think American Silver Eagles, Canadian Maple Leafs, wants rounds from reputable sources. Avoid the paper ETFs entirely. They are a bet on a financial price, not a claim on the physical metal that is in critically short supply. This is about having the asset in your possession or in secure, allocated storage. A small allocation to the right U.S. silver mining companies makes sense. They are the domestic solution to a supply crisis. Companies like Hecla and Core Mining are not just miners now. They are strategic national assets in this new trade environment. Finally, think beyond the metals market. This tariff shock will ripple through the entire economy, especially the cost of goods. If you depend on anything imported from our neighbors, from automotive parts to fresh produce, expect prices to rise and shelves to become less reliable. A buffer of essential goods is not fear-mongering. It's prudent planning. Three forces have collided: a new Fed that kills the easy money inflation trade, tariffs that fracture global supply chains, and a physical silver market that was already at a breaking point. Gold is suffering a crisis of confidence. Silver is facing a crisis of existence. The world literally does not function without it. This is the moment where the paper market and the physical reality divorce. You must choose which one you believe in. The factories of the world have already chosen. They are buying physical metal at any price to keep the lights on. Your opportunity is to understand this before the rest of the market is forced to admit it. The industrial demand for silver creates a floor that no Fed announcement can break. Position yourself accordingly before the warnings of shortages become your everyday reality.